Welcome to G Fun Facts Online, where we dive into the fascinating stories behind the headlines. Today, we're talking about a world of high stakes, secret information, and catastrophic consequences. We're exploring the domino effect of insider trading and corporate scandals. So, what exactly is insider trading? Imagine you're about to run a race, but one of the runners already knows about a secret shortcut. That's not fair, right? In the world of finance, insider trading is that secret shortcut. It's when someone with non-public information about a company, like an upcoming merger or a disastrous earnings report, uses that info to buy or sell stock. It's illegal because it rigs the game, giving them an unfair advantage over everyone else. The U.S. Securities and Exchange Commission, or SEC, is the main referee here. They enforce laws like the Securities Exchange Act of 1934 to keep the market fair, and the penalties are no joke. If you get caught, you could face up to 20 years in prison and a fine of up to $5 million. For corporations, the fines can soar to $25 million. Not to mention, your reputation is toast. But the damage doesn't stop with the individual. When a major corporate scandal breaks, it creates a ripple effect. Think of it like a rock thrown into a pond. The first and most obvious effect is the company's stock price, which usually plummets as investors panic. But the ripples spread further. A phenomenon called the stigma effect can tarnish an entire industry. When one company is caught cheating, investors and consumers start to get suspicious of its rivals, assuming similar problems might be hiding everywhere. This erodes a crucial ingredient for any market: trust. Research shows that after a major fraud is exposed, households in that company's local area actually invest less in the stock market overall. They lose faith in the system. Interestingly, in markets where trust is already low, exposing and punishing criminals can sometimes boost confidence, making people feel like the regulators are actually doing their job. Now, here's a fun fact: not all investors react the same way. While big institutional investors might see a scandal coming and trade accordingly, retail or everyday investors can behave differently. Some studies show that the number of retail investors in a fraudulent company can actually increase during the misconduct. Why? It seems some are attracted to the volatility, treating the stock like a lottery ticket. In recent years, a new kind of player has entered the game: activist short sellers. Firms like Hindenburg Research have become famous for publishing deep-dive reports that expose alleged corporate fraud. They are essentially betting against the company, and when their reports hit, they can trigger what's known as a torpedo effect, causing stock prices to dive. Hindenburg's report on the Adani Group, for example, wiped out an estimated $70 billion in market value. These firms are acting like the new sheriffs in town, policing the market from the outside. Of course, financial history is littered with cautionary tales. The Enron scandal of 2001 involved massive accounting fraud and led to the Sarbanes-Oxley Act, a law that beefed up penalties for financial crimes. Then there was WorldCom, which collapsed in 2002 after a $3.8 billion fraud. We all remember Martha Stewart, who was convicted for selling her shares in a company called ImClone after getting an illegal tip that its new drug was rejected by the FDA. And in 2011, hedge fund founder Raj Rajaratnam was busted for a massive insider trading scheme that netted tens of millions in illegal profits. The fight against financial crime is a never-ending battle. Regulators are now using advanced data analytics and whistleblower programs to catch criminals, and they're keeping a close eye on new frontiers like cryptocurrency. For us as investors, the lesson is clear: always approach investments with a healthy dose of skepticism. For corporations, the message is even simpler: transparency and ethics are non-negotiable. Because in the financial world, trust is the most valuable asset, and once it's broken, the dominoes are sure to fall. Thanks for tuning in to G Fun Facts Online. Well, see you next time.